Now coming to the presentation today that we'll be discussing. So now the election results are out, and there was also a bit of volatility in the market that was as expected in the election week. So now the dust has settled, and it's time to look forward. What's the policies are there in the place which can aid to the investors investing journey over the next 4 or 5 years. So just before that, there is a slide which we have presented last time as well, while discussing about the elections outcome and the impact on the market. So this is the slide we have presented last time as well, which captures the returns that the market has delivered after 6 months, 1 year, and 2 year post election. So you can see that irrespective of the election outcome, right, the market always ended in green in the first 6 months, right? So normally there is in the election week or very near to the election outcome, there is a lot of volatility in the market. But as soon as there is a clarity emerges on the policy side of it, right, and there is a belief that the government is going to do some bit of changes which is positive for the markets, for the economy, so then the market takes note of that. And then in the first 6 months, the market has delivered. In fact, the first year returns of the market is also quite positive, except the night 2019, which was a COVID impacted year, right? And the 1 year returns are kind of lower. So what we have observed is that there is a clear theme that the market tracks. So let's say if the government is doing well, there is a growth on the grounds, right? The economy is doing kind of well. So the market expect continuity of the government. If the government is not doing well, the growth is not there in the economy. So then the market expect a change in regime. So for example, in 2004, when the BJP lost the election, market started with a lower circuit. But if you look at after 1 year and even after the 4 or 5 years, when the 10 year finally UPA 10 year ended in 2009, so it was one of the best years for the market, although it started with a lower circuit. Similarly, when the same government started in 2009, so the market started with upper circuit. But if you look at the following 4 or 5 year returns, it was one of the decimal. So obviously there are external factors as well which impact the overall return of the market. But we don't have to judge how the entire 4 or 5 year returns would be just because of the first week volatility that's being associated with it, right? So normally what we have seen that the post election, when there is a kind of confirmation on the policy front, so there is some bit of stability that comes back into the market and actually performs at par with it delivers a positive returns. Although election has a very near-term impact on the market. So let's say the impact could be limited to 3 to 6 months. But after that, the long-term drivers of the economy, like earnings, fundamental growth, the policy takes over, and that determines the long-term return of the market. Now let's move on and understand what has changed between the scenarios that being built up before the verdict and after the election results. So before that, the market was factoring in the clear-cut majority of the BJP government, right? But the BJP come back into the power with a lower mandate and with a coalition government. So there are a lot of things there are news that a lot of things will get impacted and it will not be a proper functioning. It will not be a strong government that will be ruling the reforms. But if we have tried to break down into different reforms, how it will get impacted. So starting with the fiscal discipline part, so it's one of the most talked about subjects that since BJP has lost in rural driven states like UP and Maharashtra, so there will be something for the lower strata of the society, for the rural India, so that can increase the fiscal slippage. But in our view, we don't see that the ruling party is one which will deviate from the fiscal path, right? What it has outlined earlier. So there could be some bit of increased spending, but it will not materially impact the fiscal path that the government has outlined itself for the next 4 or 5 years. Now, the infrastructure push that it's expected to continue, as we can see that the ministries that being allocated to different ministers that being assigned to the different ministries. So that's basically a continuation of Modi 2.0, NDA 2.0. So we don't see much rejigging in that, right? So obviously after the COVID, there was a push from the government side to increase the infra spending. So in 2024, it was 25% higher than the previous year. In 25, like in the interim budget, it was 16% higher than the previous budget, right? So what we are seeing is that the increase in the infrastructure spending is there, but the growth rate in the spending is coming down. And that's what the expectation also is, that after the election, the private sector has to do the heavy lifting on the infra spending side. On other themes like digitalization, that's expected to continue. That's one of the core areas for the incoming government again. So that's expected to continue on the disinvestment side. So the in the last tenure there was not much disinvestment being done of the government assets, but in this current government regime we'll be seeing some bit of disinvestments of the PSUs, and also there are a lot of assets being built by the government on the infra side. So we'll also be seeing this investment of those infras that the government has already created. So that will again bring in some bit of revenues for the government, and that will be spent on reviving the rural economy. On the FDI side, so government has signed up FDI agreement with Nordic countries recently. In the last quarter of FY23, it has also signed FTA agreement with UK, which has paid for the FTA agreement with Europe as well. It has already signed FTA agreement with Australia. So this paves for a very good FDI, incoming FDI into the current market. And that will be a good way to look at it things. So FIA money continues to be hot money, but FDI is the sticky money, which comes there and makes the investment for 10 years or more. So that investments we see to increase in the coming years, right, under the new leadership, under the new government. On the PLI side, so PLI has been quite a genius of the Modi government, and we expect that the government continue to reward those companies which are doing exceptionally well and creating products and manufacturing output to compete at the global scale. So we see a continuation on that front. Clearly, clear energy transition has been a theme that the government has been quite vocal about in the last 1 odd years, and we see the investment into the clear energy side to go up by 4x in the next 6 to 7 years. So that's again going to be a clear focus area for the government. Domestic tourism, it's continued to be the focus area. In fact, we in the portfolio also we have ideas which are catering to it, the lightings of monuments, the lighting for the temples. So that has been a big business areas for some of the listed companies out there, and we are currently holding such names in the portfolio, and we expect that to do well in terms of what the order book visibility that we have for those names. Now, coming to the GST part, so we expect some bit of simplification. Also, the industries which are focused towards the rural side will see some bit of rate cut on the GST side. So be it like the two-wheelers or the tractor companies. So there could be some bit of rationalizations and rate cut on the GST side on that front. And lastly, on the land bill and the rural support, so we expect whatever the damage that's being done in terms of the deviation in the fiscal discipline side. So that will be a welcome to the rural support that the government is going to give. And we expect that finally the bottom state of the society will also participate in the consumption side of it, right? So overall, we see that there will be not much material impact because of the coalition government that the BJP has come back with. And overall, the reforms that were there earlier is in continuation, and we expect that to have a positive impact on the market going forward. Now, moving on. So, it's one of the most talked about themes that India is going to be the third biggest superpower globally, right? So we don't see much risk to that, and in fact, it could be easily achievable by 10 to 11% kind of GDP growth. After a point of time, it's just a number, right? You have to compound, and you will be biggest, top two, top three. So over the period of time, that will happen. But one thing to take away from here is that currently the Indian economy is at around $3.6 trillion. And by 2028, we are expected to be around $5.6 trillion, $6 trillion. So what it does basically is that every year we'll be adding in $400 to $500 billion of GDP into the economy. Now, if you look back, in 2000, the entire size of the Indian market, Indian GDP, was roughly $600 billion. So it means we'll be adding one new India of 20 years back every year going forward. And it will do wonders for that part of the country which has lower penetration in terms of white goods, which has lower per capita income. So to capitalize on that, we have onboarded themes in the portfolio which are catering to the eastern side of the country. So we have a jewelry business where we can see the compounding to happen at 25% CAGR for next 10 years. Then we have a retail franchise in place, which is catering to the region of Bihar, UP, Chhattisgarh. So there we have Jharkhand. So there we have the growth in terms of top line and bottom line to be in the range of 20-25% for the next 4-5 years easily. So, and again, there's another case that's being built up, right? So normally there are two types of investments that being done by the FIIs. The first is the active investing, where they look at the growth, the valuations of the country. The other is the passive investing, which is done by the big fund houses, right, and endowment funds and all. So when they go about doing the passive investing, so normally they allocate that much of money to the country, as per the share of that country commands in the overall GDP. So let's say today India is commanding a 3.5% GDP share globally. So the normal allocation should be in the range of 3.5%, right? Tomorrow, let's say 5 years down the line, it has to go up to 5.6%. So in that sense, the allocation to India will also increase, and that will trigger a lot of passive flows into the Indian market, which will keep the valuations elevated. But we'll discuss more about that in the later section of the presentation. If you can just move to the next slide, Prabhu, please. So there are some key reforms that the government was quite focused and actually focused on, and actually the street and the stock market has also get benefited because of that. The first was the PLI, in which government incentivizes the companies which are doing manufacturing to compete at the global scale, and a lot of companies from the EMS side, niche manufacturing EV side, has got benefit out of it. In fact, in the portfolio also we are holding companies which is the forefront of EMS industry, which is Dixon Technology. So we exited after making substantial gain in that, and then again we have rotated the money to the other EMS player and other manufacturing players. But this is again one of the key themes to watch out for. The valuations can be elevated in this space, right? Because most of the positives are already factored in. But again, the growth will nonetheless be there in that segment. The other is the PM Gati Shakti Yojana, which is again a very novel idea from the government side to focus on. Reason being, if you look at currently, the logistics cost as a percent of GDP is one of the highest for India in terms of bigger markets, right? So currently we have a 16% logistics to GDP share, right? But if you look at the developed market, that share is roughly around 8%. So with all sort of developments being done by the government, be it in the roadside railways, developing the ports, and then last mile connectivity, and then again a lot of infra being used, like wires and cables and cements and structural steel tubes and everything. So that will improve the logistics cost from 16% of GDP currently to it will bring down to 10%, which is again a lot of cost saving from the India Inc. Plus, it also reduces the transit time and the inventory levels that the companies has to hold. So that's a big positive, and it's expected to continue going forward. We are playing this theme through the wires and cable segments to the structural steel tubes that we are holding in the portfolio. Lastly, the roads and railways are the clear focus for the government for the past 10 years. So just to put things into perspective, we have been doing 10 kilometers of road every day in 2010. In 2020, in the last year itself, we did close to 35 kilometers of road per day. So going forward, that has to increase to 45 kilometers per day, right? So a lot of highways are being created. And in fact, very soon we'll be doing 20,000 kilometers of roads per year, right? So that sort of kind of growth in the infrastructure on the roads and railway sides, and railways has been a clear focus area. So obviously this themes is that it will be played out once in a 10, 15, 20 years, right? But again, in the near term, over the next 4 to 5 years, there is a lot of investment ideas which are there from that segment that one can capitalize and bank upon. Now moving upon. So the Make in India focus is expected to continue, and the electronic segment, especially the mobile part of it, mobile manufacturing, has been one of the clear thrust areas for the government. So all the PLI schemes and the EMS industry is actually a subset of this industry itself. And this industry growth rate is going to be very humongous in near future, right? So just to put things into perspective again, till 3 years back, we're doing 75 billion dollars of electronics electronics manufacturing. Today we are doing close to 100 billion dollars, and very soon in the future, let's say 7 to 8 years down the line, we'll be doing 700 to 800 billion dollars. So in 6 to 7 years, we'll be doing a 6 to 7x kind of growth in the electronic side. Similarly, for the mobile manufacturing also, we'll be doing close to 5x to 6x kind of growth in the very near future. So these stories will remain intact because of the long growth horizon that these segments provide. In fact, government has target to build an electronics ecosystem of $1 trillion over the next 7 to 8 years. So that's a very big step towards creating the electronics ecosystem, which we are missing in the previous 2 decades. So now moving on to the next slide. So infra again has been a very clear-cut focus area for the government, right? And if you look at the kind of growth that we have seen from FY19 to 24 in the last 4 or 5 years, so the railways has increased by 35%, road network spending has grown by 30%. In total, we have increased the spending on the infra by 26% in the last 4 or 5 years. So the infra spending is again going to be higher in the coming years. In fact, in the next 7 years, 6 years, we'll be doing twice of what we have done in the previous 7 years, right? So this is the kind of growth that we envisage for the infrastructure side. In fact, the very first speech, the PM has outlined the need to build affordable housing. So that's also a part of it, right? And again, if an affordable housing is being created, or the housing segment gets a thrust, so there are a lot of multiplier which is at play in the economy. So 1 rupee spent creates an income opportunity of 4 rupees, few years down the line. So that sort of kind of growth that we are seeing because of the infrastructure spending. And in fact, we are going to see a very renewed thrust in the third term on the railway side, affordable housing side, and the creation of the renewables infrastructure in the economy. So moving on. Now taking a look at how the PAT growth of the India Inc. has been in the last 4 or 5 years, and from here on what we can achieve in the next 4 or 5 years. So we can divide the entire last 20 years into the three buckets, like pre global financial crisis, then GFC to COVID, and then post COVID. So obviously the period between GFC to COVID has been quite a dormant year for the India Inc. Right, the growth rate was benign. It was mainly because there was a lot of NPAs in the system, and a lot of industrials, infra-oriented companies were again coming out of the shock of the GFC. So there has been a very moderate growth, and the consumptions, banking, quality business were there at the forefront, right, in terms of delivering the earnings. But in the last 4 or 5 years, what we have seen that there was a policy reform change when government did the cut in the interest rate, cut in the tax rate for the corporate side, right? And because of that change in the interest rate from 35, change in the tax rate from 35% to let's say 20%, it has given a new lease of life to the India Inc. And after that, we are seeing the profitability of the India Inc. to grow at a very rapid pace. And if this profitability even has to maintain 20% CAGR for the next 4 or 5 years, then it means that whatever the valuations number that we are currently looking at, it should be at least 30-40% lower in terms of 4 or 5 years down the line EPS that we'll be getting, right? We'll be looking at those companies. And also from a profit to GDP ratio, I think we are currently at around 4.45%. And that's expected to go up to 6-7%, 4 or 5 years down the line, because of the increased profit pool that's been created by the India Inc. So now let's look at what it would, how it would impact the overall market. If you can just move to the next slide, please. So the earnings is one of the things that's supporting the market, but again, there is a very important factors which is keeping the valuations of the India Inc. elevated, right? So in our interactions with the family offices, distributors, we constantly being asked this question, that are these current valuations justified to put money? Because clearly we are not cheap, and the valuations are expensive. But this chart will answer that question in some way. So currently, if you look at the FII ownership that we are currently have, so it's around 16.6%. It's at a decadal low. So in the last 10 years, we have not seen the FII ownership at a 16.6%. And it's not like because of the design they have chosen to be underweight, right? So if they have to sell Indian markets, they have to go anywhere else in the world and they have to invest. But nowhere globally, the countries are making return what the Indian market is making return. And they have remained underweight because of the fact that the domestic investors are coming in hordes to buy the domestic equity. We have seen the retail participation increase to 9% in the Indian markets, and which is at the lifetime high level. So clearly, whatever the retails are buying today or the domestic investors are buying today, so there has to be a buyer, and unfortunately that seller, there has to be a seller, and unfortunately that seller is the FII. So because of which, they have turned net sellers. Again, if you look at the weightage of the India in the MSCI universe, right, MSCI emerging market basket. So before COVID, the Indian weightage was around 8%. Post COVID, it has gone up to 18%. And then in the last 5 years, the weight increase in the MSCI basket is so swift that the FIIs are finding it difficult to maintain and keep the weightage as per the MSCI prescribed mandate, right? So currently they are 0.5% underweight, and if they have to become let's say 0.5% overweight, that will trigger in, let's say, 18 to 90 billion dollars of inflows into the Indian market. And if we look back and see how much investment these FIIs have done in a particular year, so at max they have done 25-30 billion dollar in any given year. So today the Indian market is not ready to absorb that sort of liquidity coming from the FII side. If that has to come, then clearly the valuation will go for a toss, right? So it's good that we are seeing some bit of careful approach from the FII side. But the important takeaway here is that those who are waiting for the correction to put money into the market, yes, there could be a possibility of 10 to 15% correction any day in the equities market at such levels, but that correction will be quickly bought into, and will not see that correction to sustain for a longer period of time. And one sort of thing we have recently seen in the concluded election verdict, that even with the BJP coming up with a lower mandate, there was a 1 day of volatility which was easily bought it the next day itself, and after that the market is in uptrend. So there was no opportunity to again buy at the same lower price. So this gives a comfort that there could be some bit of buying again will be happening if there will be a correction in the Indian market from the FII side. Now moving on. So just to conclude that, even that, let's say we're kind of expensive markets today, and the valuations are trading at a premium of 5% for the large caps, 10, 15, 20% for the mid and small caps. But the earnings projections that we have for the market is very, very robust, right? And we are currently seeing close to 18 to 20% kind of compounding be done in the small and mid caps. For our universe, which I will discuss later, that what sort of compounding that we are expecting from the market, but it's in high double digits, close to 18-20%. And even with higher valuations, let's say if there is a 1 year of price correction or time correction in the market, so we will just lose 1 year, and after that again the earnings are there to justify and give the necessary growth to the overall portfolio. So what we believe is that the risk is on sitting outside the market currently, right? And whatever the easy return that we had to see in the previous 2 years, that's already been made. So a lot of returns have been made in segments like infra, PSUs, and defense names. So we have seen one-time multiple rating happening. In fact, some of the infra names, if you go back and check, the last 1 year return is around 120, 135%. And 115% is just attributed to the multiple expansion of that industry, right? And only 15 or 10, 15% is from the earning side. So the easy return period for the PSU names, momentum names is behind us. And what's our experience of the previous elections tells us that the PSU names, infra names, government focused names peaks out post-election around budget, and after that quality takes control. And for that, we have created a very quality-oriented portfolio. The returns have been lower than the peers in the past 1 year, and we are okay with that, considering we don't want to take excessive risk. We don't want to get into a situation where we are buying at a higher elevations, higher valuation levels. And then once the cycle turns, then we have a bleeding portfolio at our hand. So we are okay with holding a portfolio where we have sufficient earnings predictability and the valuations are also comfortable. But I will leave that for the Vijay to discuss. So over to you, Vijay, now to take on the portfolio discussion side. Thank you.
Yeah, thank you, Prabhat. Now we will move on to the next section, the investment landscape, where we will try to uncover the themes which can have disproportionate tailwinds in the next decade. So for that purpose, what we have done is, so we have studied the developed economies, developed countries cycle, and when they were passing through the GDP per capita mark from, let's say, $2,000 to $10,000, which were the sectors which benefited disproportionately, and we tried to uncover that. So in this slide, what we have captured is the per capita income. So India is somewhere around $2,000 mark. Currently, it's around 2.5K. The data is a little bit of 1 year old. But when the countries like USA, Japan, and all these developed economies, when moved from $2,500 mark to 3,000, 5,000, and eventually 8,500, there were different sectors which got the disproportionate benefit, such as real estate, credit, branded retail, mobility, again electronics, durables, consumer durables, recreational activities, credit. So all these things, if we summarize, there are three key trends which are clearly visible. First is the real estate, which is the housing. Second is the consumer discretionary, and third is the finance. So why these sectors get disproportionate tailwinds or the spending? So the reason is very simple. So when we uncover the facts, we came to understand that when the GDP per capita goes up, it directly translates into the higher income per capita. So once people have excess income and their necessities have been satisfied, the people are spending more behind buying their own houses, or let's say investing in real estate. So there is a boom in building materials products. Apart from that, the necessities are satisfied, so they will also spend on the discretionary products. That will also lead into the boom in the, let's say, retail kind of activities, let's say the branded apparel or the electronics. Those kind of like sectors get disproportionate attention from the consumers. And the last one, which is the finance, to fuel this rally of, let's say, the spending behind the real estate and spending behind the consumer discretionary product, people will take loans because people are more confident of their future income because their income has gone up and their necessities have been already satisfied. That confidence is always there. So the personal consumption on the finance side, the credit growth also gets disproportionate reward. So these are the three sectors which we understood from their side. Now we will just put these things into the proper numbers to understand how these sectors will move on. So in this exercise, what we have captured is, so our nominal GDP is expected to grow. It's a very conservative estimates of 9.6% CAGR to around $8 trillion, which is $7,900 billion by FY32. And the total retail market, which is 41% of the current pie, which is $781 billion, is expected to grow at around 9% CAGR to $1.8 trillion. But if we divide that retail market into the two sub-segments, which is the grocery retail and the non-grocery retail, which is the consumer discretionary section. So the necessities, which is the grocery retail, will only grow at 6.5% CAGR. But the consumer discretionary section, which is $282 billion, will move up to $900 billion at a 12.2% CAGR pace. So that is reasonably higher. It's almost 2x of the necessity or the grocery retail growth, and also 1.3 times higher than the nominal GDP growth. So this is how the three sectors are coming into our focus. Like these three sectors will have disproportionate benefit. Apart from these three segments, there are also some segments which are getting disproportionate attention from the government side. So we have also analyzed those. Please move to the next slide. Yeah. So apart from finance, building material, and consumer discretionary, these three spaces, there are also three another space like manufacturing, capital goods, and renewable energy. These are getting disproportionate focus from the government side. So as we know, like we have around $160 billion of exports as of now. So government is focusing around by 2030, we should increase these exports of the manufactured goods in India to almost $500 billion. So they want to triple the manufacturing segment with the help of around 10 to 11 sectors in the next 7 years. Coming to the capital goods side, so our budgetary capital allocation for the government capex side was around 11.11 lakh crore, which was a 11% jump from the previous year. But we expect the growth in the infrastructure boom and the capex side to continue at moderate pace and a healthy pace of around, let's say, 13 to 14% CAGR for the next 5 years. The last one is the renewable energy thing. So it's a quite interesting one. So we are going under the energy transition. So right now we are around 180 gigawatt of renewable energy capacity. And the government has clearly mandated that we need around 500 gigawatt of capacity by 2030 from the renewable energy space side, which means that 45 gigawatt will be added from the renewable energy side for the next 7 years. Each year, we will see the 45 gigawatt addition being done by the government on the RE side, which is the renewable and the clean energy space side. And the biggest beneficiary will be the solar, which will go up from 73 gigawatt to around 280 gigawatt in the next 7 years. So these are the 6 themes which will be like a having disproportionate benefit in the next 5 years. And the key risk always will be like the geopolitical tensions, or let's say some unfavorable or adverse developments on the global side or the inflation side from the macro side. So in a nutshell, these are the 6 themes that we have identified. Now we will understand, or we will try to discover like how we can pick the particular businesses from these 6 sectors. So for that, we will just spend a few minutes on our internally developed and trial and tested model of multi-bagger framework. So those of you who are new to our the webinar series, so for that, for the benefit of those, we will spend a few minutes. So our multi-bagger framework is dependent on the 2 legs. It has 2 legs. Basically, one is from the growth side, second is the value side. So growth, we target basically a business which have at least, let's say, the earnings visibility of earnings growth should be at least 2x in the next 4 to 5 years. So let's say the profit is 100 crore today. So we'll try to pick businesses. We will aim towards the profit should grow up from 100 crore to 200 crore in next 4 to 5 years. A second leg, which is the valuation. So we will not buy a business which is trading above the fair valuation multiple, or which is trading at the, let's say, the premium to the industry, or which is let's say that a disproportionate absolute premium. We'll always go for a business which is trading at a discount to industry, which is always at a discount to the leader as well. So let's say if earnings are going to double and the valuation which is trading at a 50% discount is going to merge with the industry leader multiple. So we'll also see the valuation upside of 2x. So if you multiply the 2x into 2x, we will get around 4x kind of upside from a particular business. Of course, we believe we will not be right in every thesis that we prepare. So we are cognizant of the fact, and we typically build around 25 to 30 stocks portfolio, and which is diverse across various segments, which protect us in case of some adverse development happens. Let's say 25% of the thesis don't play out as per our plan. So we are okay with the 75% of the companies going as per plan and delivering healthy CAGR in terms of, let's say, around 20% earnings growth from the 4 to 5 year perspective. Also now, we strongly believe at RH that risk and return are part of our investment process. So when we are talking about the returns and growth, we also have the integral framework of risk management, which is embedded in the investment thesis. So we typically look risk from the 3 perspectives. First is the business. So we typically avoid businesses which have low earnings predictability and the competitive advantages are narrowing down. We also don't pick businesses which have a valuation risk, which are trading at a very high reasonable multiple, and there is a low margin of safety. And the third is the corporate governance risk. So we don't like the management or the promoters which are misallocating of the which are practicing the misallocation of capital. Also not transparent to the minority investors, and the disclosure quality is also poor. So these 3 risks have also these 3 pillars have also protected us from committing a few mistakes in the past. And we will also take one case study to explain that how this process has helped us to deliver strong returns for our investors. So one of the business that we used to hold in last cycle was APL Apollo Tubes, and we entered it around 33x PE. And when we exited, the PE was around 55x PE. The earnings had almost gone up 3 times. The PE multiple expansion happened around 1.7 times, which led us to the 5x gain for our portfolio. But what we witnessed somewhere around the Q3 FY23, if we look at the left side graph, which represents the sales volume. So the sales volume started to stagnate around 6 lakh ton per quarter. And the growth, which used to be more than at least 20% on year-over-year basis, it started to go down below 15%, 10, 11%. And in the Q3, the growth was almost flat, Q3 FY24. So during that time, we envisioned is that the growth is tapering down. So valuation premium will go down, and also there will be stagnation in the market capitalization of the company. And we decided to exit the business, and we moved on to the different business from the same industry, which we have captured in the right side of the chart, where the quarter-over-quarter growth was 24%, and the year-over-year growth was around 76%. So this was the emerging steel tube leader that we moved on. So this is how we practice the entry and exit in a particular business using our risk and return methodology. Now we'll move on to the themes, which in our humble opinion will translate into the solid returns for the investors. So as we discussed from the six sectors that we discussed earlier, so we have picked around 25 to 30 businesses in our portfolio from those six segments basically. But we have tried to capture the 5 top themes that we think are we are strongly bullish on. The first one is the steel pipe, second is the wires and cables, third is the paints, fourth one is the renewable energy business, and the last one is the NBFC MFI. So the first one, which is the steel pipes. So the business that we have identified and picked in our portfolio, it's trading around 30x P 1 year forward, and the sector P is around 60x P. So the discount to the industry is around 50%, or the sector leader is around 50%. And we are expecting the earnings to grow at least 2x in the next 5 years. So if we combine those 2.5x into the 2, so the return expected on the bullish side or the blue sky scenario will be around 5x in that particular space. Similarly, if we look at the wires and cables or paints or renewable energy space and the NBFC, the returns are expected around 3x, 4x, 5x, and 4x. So this is how we have picked the themes from the future development side, where we think like this process of these segments will have disproportionate benefit. And the process that we have developed at RH in the last 6 years of the managing the funds, it is also visible into the returns that we have generated for our investors, which is, we can move to the next slide, please. So this is where we have captured the journey of super value. So the returns from the super value are around 35% CAGR from the since inception versus the relative benchmark of around 22.7% CAGR. And the 1 crore invested has become almost 2.9 crore and versus the index of 2 crore. So the risk and return framework which we have developed helped us to outperform in every cycle, and it has also helped us to pick diverse businesses from the various sectors. One of the key contributors to our performance was one of the business that we would like to highlight was the KEA industry, which was from the wires and cable side. So when we entered this company somewhere around May 2019, we met the management, and the management clearly mandated that they wanted to increase the capital efficiency or the ROCE of the company by cutting down the EPC business that they used to have. And they wanted to clearly focus on the B2C space, which is a high margin and high capital efficient business. And we somewhere understood them, and we entered the business somewhere around 350 rupees. We still continue to hold this business. It's trading around 5,000 odd rupees. Yesterday, it made a high of around 5,040. And we have generated around 14.5x return in this business. So this is how our processes have helped us to pick the tomorrow's leaders in the present time. And in the last 5 years, we have picked more than 20 multi-baggers in this journey of using this framework. So we have captured few of the last cycle multi-bagger for the benefit of all, like IRCTC, GMM, Fodler, which are coming from very different space, starting from IT, or let's say the paints or the chemicals or the wires and cables or the finance or the EMS space, or let's say the even finance side. So this is how the strong processes helped us to make a diversified portfolio which can perform in every cycle and benefit to the consistent returns for our investors. In the end, in summary, we think that we strongly believe in the India growth story. And if anyone wants to be the part of this journey with RH, so please feel free to get in touch with our team. And thank you, ladies and gentlemen, for listening us patiently on this Saturday morning. Thank you, and over to you, Prabhu.
Yeah, thank you very much, sir. We will now begin the question and answer session. So the first question is, what's the scope for energy transition and
So that was all, Prabhu, like energy transition in general.
yes, sir, just in
Yeah.
general.
Yeah. So right now we will put a landscape like we have around 500 gigawatt of energy capacity in India. So what government wants to focus is now government wants to clearly increase the capacity of renewable energy space. So government has made policies like the future power plants should mainly come from the renewable energy side. And we have seen it happening. All the captive power plants or the independent power producers are using non-traditional fuels, like not the fossil fuels. They are using either the solar or the wind as a key ingredient for the power production. If we take example of the private players where we met recently in the last 1 year or last 4 quarters, the major capex happening from their side is happening mainly on the renewable energy space. And if we talk about the largest beneficiary will be the solar energy, because of the large availability of sunlight in India and the consistency into the energy output per solar cell that they can generate with a consistent capacity. So currently we have around 73 gigawatt of solar energy capacity. It will move up to 280 gigawatt. So it's around 30 gigawatt addition for the next 7 years, which will translate to 210 gigawatt of additional capacity. So the solar energy will be the, let's say when we reach the 1000 gigawatt mark by 2030, so the solar energy will be around 28% of the total energy pie that India will be consuming. And the way the renewable energy will be around 50% of the current energy of the future's current energy portfolio. Right now, it's somewhere around 30%. It will move up from 30% to 50%. This is how the energy transition will take place over the next 7 years. Ideally, in our humble opinion, it should play out into the current government period, and the businesses that will get disproportionate benefit. So we have already identified and like picked in our portfolios as well, and it has done well for us. So I think in a nutshell, it will be like a long-term 5-6 years kind of trend. It's not a short-term story of energy transition. It may also take maybe, let's say, one more government period, or let's say the one whole decade before we see the complete energy transition. So that is how it is. Yeah.
Yes, thank you, sir. Adding to that, the question is whether do you think railway and renewable energy themes are fully priced in currently?
So it's again case to case basis. So in renewable energy space, there are a lot of businesses which have lot of disproportionate capacities which will be coming online. So we don't think it's completely priced into the renewable energy space. Of course, one needs to conduct the independent analysis. Lot of companies which are talking on the whether they are doing as per their actions are matching their words or not. That should be the independent consideration before investing in those things. And whenever there is a particular hot theme, so the mistakes or the probability of mistakes also go up. So it's better to conduct separate analysis and take call on that thing front. But we have a lot of businesses which, in our opinion, from the renewable energy space, which will have like disproportionate benefit. And we think like a lot of future is yet to be priced in. Coming to the railway side, so railways capex has always the story has played out in our humble opinion, and there will be still maybe some routine maintenance capex which will go up, like, and it can have like continuous benefit to the sector. But again, there will be some particular businesses which will be getting too much attention, or let's say the small SME businesses which are also listed on the exchanges now. So there are 3-4 different businesses or the small cap promoters which we met, and those businesses have still long room to grow. It has nothing to do with the particular sector because they are too small, so they will get disproportionate benefit because of the low base effect. So it's a independent call. So one can conduct an independent analysis and take care of the valuation, how much future is priced in. But we think there are ample opportunities in both the space, yes, to be priced in of the future. Yeah.
Yeah, thank you, sir. The next question is about real estate. So the sector has already rallied so much. So do we see, are we playing it through strong RE developers? If not, then why is the question?
Right, Prabhu. So it's on the real estate side, right?
Yes, sir. Yes.
Mhm. So yes, we are playing it through the strong RE developers. We are holding a leading real estate developer from the north in our portfolios, and we are very confident of the order book, the sales realization that the company is delivering. But coming back to the real estate sector, so the housing demand has been very robust in the economy for the last 3-4 years, especially post COVID, as we have seen the increased savings in the hand of consumers, right? So the increased saving is actually finding its way to the real estate demand, and also COVID has intensified the demand for, like, the big projects. So what we have seen in the past 4-5 years, that the luxury projects, the high ticket size projects have done well. And in the last 3-4 years as well, like, the organized players which are bigger, which have, like, better balance sheet, have actually gained market share from the unorganized players. So this has been a very clear theme, and we expect that theme to continue to perform in the next 4-5 years as well. Coming to the specific, like, how the companies have performed. So the real estate market, the sales have really been higher by 25-30% on a year-on-year basis. In fact, if you look at the realization also on the real estate projects, so that has gone up by 35-40% because of the increase in the land prices and corresponding unit sizes, unit prices as well. So, and if you look at the inventory level also, so the inventory level is at the decadal low currently, especially in the markets like NCR, Bangalore, Mumbai. So there we have seen the inventory level going down by a huge margin because of the renewed demand and thrust. So what we believe is that the current market size of the real estate is around $300 billion roughly, and it can go up to $1.3 billion by 2034, and it will be a more than 4x in the next 10 years. So it's better to associate yourself with the listed players which have, like, more balance and strength. They have the flexibility to raise capital by diluting equity and all. So those are the companies one should bank on, and we are currently having, like, such companies in the portfolio to play the real estate theme. Thanks, Prabhu.
Yeah, thank you, sir. So the next question is, with respect to large, mid, and small cap to enter the market from a risk reward perspective and also from a valuation perspective. So which pocket looks attractive and where are we looking for more ideas?
Right. Prabhu, can you quickly go back to the slide, which was the last slide of my presentation? So there we have some data that we can discuss, and then we can take this question. Yeah, this one. Right. So on the mid and small cap side, we have seen a very good rally. In fact, the index level, we have seen the returns excess of 50%. And that happens very few times, that when the index delivers more than 50% CAGR returns. And, like, more of the active management funds find it difficult to beat the index return. But that's exactly what happened in the last year, right? And if we look at the kind of growth that has come in from the EPS growth, right? So what we have seen in the last 4-5 years, the earnings of the mid and small caps have grown in excess of 23-24%, right? For example, the 5-year CAGR for mid cap index is around 23%, and the small cap 250, the 5-year EPS CAGR is around 28%. So this excess of 20% EPS growth we are seeing after 10-15 odd years. We have seen that sort of earnings growth in the cycle between 2003 to 2008. But the entire period between GFC to COVID, we have not seen any meaningful rise in the EPS growth. It was hardly 5-6%, 7-8% for the better doing companies, right? So that's finally the earnings breakthrough we have started to see, and that has actually supported the valuations. So if you look at, like, there are two components, as Vijay has explained, of the price increase. One is the EPS growth, and the other is the valuation expansion. So if a valuation expands itself because of the sentimental factors, then it's not sustainable. But if a rally is coming because of the increased growth in the earnings of the company, then it's kind of sustainable and prolonged also. And just to put things into perspective, now that we are comparing earnings with the previous cycle of 2003 to 2008, so we are delivering similar sort of earnings in this cycle. But if you look at the kind of stock price growth that we are currently delivering, it's not even 1/3 of what we have seen in the previous cycle, in, like, midway of the cycle. So we have a lot to catch up on the mid and small cap side also. And if we talk about the previous bull cycle of 2018, or in fact 2022 also, right? So whatever the valuations that we have seen at that point of time, that's clearly 20-25% higher than the current valuations that the mid and small cap is commanding. So valuations is not an important factor currently. Like, it's a very simplistic factor to look at. like, valuations are expensive, so we should not invest. But if it's coming from the underlying growth, if we have a construct where, like, retailers and the DIA participation increasing, we have an under-owned FII market as well. So that's make a case that, like, we remain invested in the segment. Obviously, the leadership will change. So whatever the sectors that have performed just because of the multiple expansion in the previous 2 years, that's going to rotate to more secular, more growth oriented names. And especially when there will be a rate cut. So please understand that whenever there are two sort of businesses, like, which are currently there in the market. So one is the momentum, the other is the growth, right? We are not talking about the cyclicals and the other businesses, right? For that moment, for this moment. But like, if you compare, so the momentum is running because of the sentiment, because of the government's announcements, because of the order book announcement by the companies, and the growth companies are basically lagging behind because the terminal value is not getting right, because, like, currently we have higher interest rate environment, and it deeply impacts the terminal value of the companies, which lowers down the share prices. So that's why we have not seen any sort of material valuation rating happening in the quality names. Momentum names have seen meaningful expansion in the valuations, right? 2x, 3x, 4x, you name it, and it will be there for sort of companies, right, which are out there. So in terms of valuations, we are quite comfortable with the kind of companies that we are holding. For an investor who likes to run his own portfolio, so it's a time that you start trimming out, like, profits and booking profits from those momentum names, right? Probably it will peak out around the budget announcement time, and then, like, kind of start rotating it to the more quality names, more names which are bottom up, and, like, have a lot of earnings trigger in place, right? So those names will make money going forward in the markets.